Good morning, everyone, and welcome to Weekly Profit Talk. We do this every single week at 8:30 a.m. Mountain Time. That is 7:30 if you're in California, 10:30 if you're out in New York. So, good morning, everyone. Welcome. This week's Weekly Profit Talks topic is mid-year tax checkup for private practice owners. Um, I can't think of a better time to take a look at the financial health and well-being of your private practice. And there might be some spillover here for people that aren't doctors but are running a small business as well. So if you're not a doctor and you happen to be tuned in, hang out with me for a few minutes. We're going to try to keep it under 10 minutes anyway. So we're not going to eat up too much of your morning here. Anyway, mid-year tax checkup for private practice owners. Let's go ahead and launch into this. First thing I want to talk about is the safe harbor illusion. This is basically um, where you get your tax return for 2025, for example, and you got that done by April 15th, hopefully. And one of the things that a lot of tax preparers software does, or your own software, I think TurboTax does it too, is it'll churn out four vouchers for you to make estimated tax payments if you, in fact, owed tax in the previous year. Um, this is generally the tax you owe divided by four, or it could be 90% of the previous year's number. There's a couple of different ways that the IRS requires you to make a certain minimum amount of payment. We like to throw all that recipe out the window and basically go like this. You want to look at the performance of your business in each of the four quarters. Um, Now, in IRS terms, the quarters are weird. The first one is an actual quarter, January through March. Estimated tax payment deadline is the following 15th, April 15th. Happens to be the same day as the 1040 deadline, so it's easy to remember. Second quarter is only 2 months away on June 15th. Now, the reason we think they do that is because the third quarter ending on September 15th gets a bunch of money into uh, the Department of Treasury before the end of the fiscal year, which is the last day is September 30th. Fiscal year is different than the calendar year for the federal government. So that's why we think that is. So anyway, you have a 3 month quarter, 2 month quarter, 3 month quarter, and then you got January 15th, where you're actually able to um, make an estimated tax payment based on actual performance, provided that you got good information from your books by then, and make a really good payment. But in the interim, what you want to do is take a look at the performance of your business each quarter, be that 3 months, 5 months, or 8 months. Calculate your estimated income for a whole year, figure out the tax on that, divide back, and of course, subtract any previous estimated tax payments that you made. So the safe harbor illusion, let's get into this. You can pay roughly what you owed last year, and that's a thing you can do. The IRS won't penalize you for underpayment if you are making that certain minimum amount of money, but it says nothing about your actual bill. Now, if you're new in practice and you're building and scaling your practice every single year, word of mouth's getting out, you're getting more well known, you've got more money each year, year after year. That's basically what you want to do anyway. But there's a two-edged sword here because you want to also make sure that you're keeping up with the growth of your business. If you make the tax payments that you made last year, you're going to find yourself the following tax season of March and April scratching your head going, why for do I owe so much more tax? So, Safe Harbor doesn't tell you what you're going to owe. It may be perfectly legal, and also it's going to be completely insufficient if you're scaling and growing. You're not going to find out until next April with a number that you didn't even budget for. And I'll tell you, it's a nasty surprise. So there's three things worth checking before the September 15th deadline. This date is not a suggestion, it is a real deadline, and it's the last checkpoint before the fourth quarter turns every small miscalculation into a large one. Scary words, but what that means is if you have, in fact, been kind of hallelujah guessing at your estimated taxes the rest of the year, January comes and you got a pretty good idea what you're going to owe in tax, and you're actually like really terribly far behind, you're not going to like it much. One thing is you're probably going to pay underpayment penalties for making too small of payments earlier in the year. So there are three things that are worth looking at right now in the middle of the year. First of all, let's do a year-to-date profit and loss. what better time? You're basically in the home stretch. July 4th, I always like this holiday because basically a brand new quarter and the second half of the year begins a couple, 3 days prior. And then we all celebrate America's birthday and get back to work after that. And you're basically launched into the third quarter. I can't think of a better time to compare honestly against what you assumed in January. Not what you hoped for, but what actually is happening. Another thing, number two, your owner compensation. If you're an S corporation, then you're aware of the fact that you are supposed to and should be taking a reasonable salary from your business. Now, reasonable is the lesser of one or two things. Either around half of all the money you're making, or if you're making quite a bit of money, then it should be the cost of replacing you with someone of equal proficiency. So let's say you're a physician in a specialty and replacing you may cost, let me think of a number that's divisible by 12. How about $288,000 a year? That sounds good, right? Because that's $24,000 a month. Um, and if you're making 600, 800,000 a year total, including that revenue, excuse me, including your wage, then you're looking at about $500,000 in net income, but your compensation is reasonable because you're paying yourself what it would cost you to replace you. So, but if you're new in business and you're basically your last year was a couple $100,000, nobody expects you to pay yourself $288,000 that you don't have either. So you want to be somewhere around 96 grand in that case. Hopefully that makes sense. But you do want to take a look at your owner compensation year to date. 6 months have elapsed, you got 6 months to go. If you're underpaying yourself, huge red flag at the end of the year. Reasonable compensation means if you are going to make $250,000 and you're paying yourself like 48,000 in wage, that's not enough. And if the IRS picks you up on an audit, you're going to pay all that back. Chances are you're also going to be penalized for behaving fraudulently. So you do want to continue to take a look at your reasonable compensation. That was worth going off on a little tangent about. So number three, you want to look at the bookkeeping itself. Your accounts need to be reconciled. Now, what does that mean? Well, your bookkeeper should be going to your bank statements or your online banking and actually checking that off against your records and making sure that all the transactions match up. Every other decision on this list depends on numbers you can actually trust, and that's why reconciliation is key. You want everything coded so that it goes into the proper categories. You know what you're spending your money on for cost of goods sold, for staffing, and then all the other selling and administrative expenses, including the rent that you're spending, all those things. So it's important that your bookkeeping is up to date as well. None of this is glamorous, but a mid-year look at the numbers is exactly what keeps a good year from becoming an expensive surprise next year. You may be busting out all giddy up this year so far, and it may feel good. Keep up with your taxes. I honestly, if you take nothing else away from this, understanding that good estimated tax payments keep you from having a nasty surprise when you file your taxes. There are two reasons, and I'll get to that after we look at this. The 6 month mark is a gift. It's not a deadline. Your deadline occurs June 15th, and you had that already. So the next one is September 15th, as we just stated. It's not pressing down on you. It's the rarest thing your calendar offers, which is time with information. July has begun by now, and you're watching this on the 8th of July. Under normal circumstances, my drop dead deadline for my clients is they have their financial analyses and all of their statements and understand their numbers by the 10th. You should too. You really ought to know what your profit and loss is for the first half of the year by now. Okay, so if you don't, maybe we should talk. You know more about this year now than you guessed in January, and you still have months left to act on what you know. So, a real mid-year review is not about predicting the rest of the year perfectly, but it is about trading the guess that you made in January for the actual facts that you have now before that gap turns into a huge bill. And yes, it will have your name on it, like it says there. So, it's important to note here at this point that um, underpayment penalties will occur if you owe more than $1,000 in tax at the end of the year, beyond the amounts that you've already made estimated tax payments for. So let's say, for example, you've been throwing a couple 3,000 bucks a month at your estimated taxes. You've got $9,000 in there after September. January comes around, and all of a sudden you're looking at your year end and you go, holy for goodness sakes, you're going to owe $20,000 in tax. Okay, so the possibility exists that you may have the remaining $11,000 someplace, and you can make that as an estimated tax payment in January. But understand that if you analyze your payments, and they will, you have to put the payment amounts on the dates in your tax return. And if you underpay the first 3 quarters, you're going to pay an estimated tax penalty anyway, because they calculate it for each quarter. If you want more information on that, you can Google Form 2210. That is the estimated tax calculation. So, um, making good estimated tax payments each quarter also matches the expense of your taxes to the period of time in which you're making the money that created it. So, it's just good, solid fiscal practice, and I'd love to see it as to the period of time in which you're making the money that created it. So, it's just good, solid fiscal practice, and I'd love to see you paying as little as possible to the IRS. You you're already paying 5 figures as a successful position. Don't pay a penny more than you have to, and that's what I want to leave you with. So, uh, if you'd like to know more information about how I make this easier for our clients, you're either watching this live or on replay on one of three media: YouTube, LinkedIn, or Facebook, of course. And all three of them have a comments capability. What you want to do if you'd like to get more information, first, you can just write me an email. It's Eric with a C at owingsllc.com. But you can also just drop down to the comments whatever you're looking at right now and write help, more info, free consultation, because the first one is free. And we'll get back to you and we'll tell you how to book that. And I'll talk to you personally for between 30 and 45 minutes, and we'll see if it resonates working together. We can save you 5 figures in taxes and also increase your profit and your cash. I am 100% confident. So if you're interested in learning more, reach out and let's talk. In the meantime, have an amazing rest of your Wednesday, an awesome weekend. Stay cool in the heat wave. And if you have a chance today, do something randomly kind for